Over the past week, the Forex market experienced notable movements influenced by various economic events and geopolitical developments. Here's a summary of the key events and their impact on major currency pairs. Pound sterling to US dollar, sterling's performance. The British pound reached a one-week high against the US dollar, trading at $1.2548, its highest since December 31st. This appreciation was partly due to reports suggesting that U.S. President-elect Donald Trump's advisors were considering applying tariffs only to critical imports. Additionally, the pound's strength was supported by discussions around the Bank of England's monetary policy, especially following a downward revision of the UK's third-quarter GDP and a vote by 3 members of the Monetary Policy Committee for an immediate rate cut in December. The British pound, GBP, saw notable strength against the US dollar, USD, last week, reaching a one-week high of $1.2548, its strongest level since December 31st. This upward movement in pound sterling to US dollar can be attributed to several key factors. US tariff policy speculation. Reports surfaced that advisors to US President-elect Donald Trump were considering implementing tariffs only on critical imports. This potential shift in trade policy reduced fears of widespread tariffs, which initially weighed on global risk sentiment. As a result, investors sought safer assets like the pound, boosting its value. Bank of England's BOE monetary policy stance. The pound's appreciation was also supported by discussions around the BOE's monetary policy. The central bank's decision to maintain interest rates amid ongoing economic uncertainty was interpreted as a sign of relative strength in the UK economy compared to other regions. Third-quarter GDP revision. The UK's third-quarter GDP growth was revised downward, indicating slowing economic momentum. Despite this, the BOE's cautious stance helped maintain GBP's strength against the USD. Monetary Policy Committee, MPC, votes. The vote by 3 members of the MPC for an immediate rate cut in December highlighted concerns about economic slowing, but this did not lead to drastic changes in monetary policy. The market interpreted this as a balanced approach, supporting GBP. The broader market sentiment also played a role. With improved global risk appetite, traders moved away from the traditionally safer USD, favoring currencies like the pound that showed resilience amid economic uncertainty. The pound sterling to US dollar pairs movement was also driven by technical factors. The $1.2548 level acted as a psychological resistance that, once broken, led to further buying momentum. Traders watched this key level closely, and as it held, confidence in further gains grew. The pound's performance against the USD last week was driven by a combination of external trade policy shifts, cautious monetary policy, and improving market sentiment. Going forward, traders will likely watch for any updates from the Bank of England and US economic data, which could further shape the direction of pound sterling to US dollar. US dollar to Indian rupee. Indian rupee's challenges. The Indian rupee faced significant pressure, hitting an 8-month low against the US dollar. This decline was attributed to the Reserve Bank of India's interventions to stabilize the currency and global economic conditions, including reactions to US and Chinese economic actions. The government's foreign currency reserves also declined notably, highlighting the challenges in managing the rupee's value amid weakening Asian currencies and global investor behavior. The Indian rupee, INR, experienced significant challenges last week, hitting an 8-month low against the US dollar, USD. This depreciation was driven by a combination of domestic economic conditions, central bank actions, and global market factors. RBI's interventions and currency stabilization efforts. The Reserve Bank of India, RBI, stepped in to manage the volatility in the currency markets. As the rupee weakened, the central bank used its foreign exchange reserves to stabilize the INR. However, this move was not sufficient to prevent the currency from sliding to its lowest level since May. The RBI's interventions aimed to curb excessive depreciation, but global pressures, especially from US dollar strength, limited the effectiveness. Global economic sentiment and dollar strength. The US dollar's broad strength, driven by expectations of tighter monetary policy in the US, put significant downward pressure on the rupee. The strength of the dollar, supported by U.S. economic data and potential interest rate hikes, led to weaker currencies across emerging markets, including the Indian rupee. Additionally, China's slowing economy and its effects on global trade impacted investor sentiment, causing capital outflows from Asia, including India, and pressuring the INR further. Declining foreign currency reserves. India's foreign currency reserves have been on a declining trend. As the INR weakened, the government's ability to maintain its reserves without spending heavily became a concern. Foreign exchange reserves are crucial for defending the currency in times of depreciation. The depletion of these reserves highlighted the ongoing challenges faced by India in managing its economic stability amid weakening Asian currencies and a flight of capital due to global economic uncertainties. Asian currencies weakening. The rupee's struggles are part of a broader trend across Asian currencies, which have all weakened against the USD due to slowing economic growth in the region, trade imbalances, and capital outflows. The INR's depreciation reflects these regional economic vulnerabilities and the global risk sentiment affecting emerging market currencies. The Indian rupee's decline to an 8-month low was largely driven by a combination of RBI interventions, global economic pressures, and the weakening trend in Asian currencies. Moving forward, traders and policymakers will focus on further U.S. economic data, actions from the RBI, and any signs of stabilization in global market sentiment that could potentially ease some of the downward pressure on the rupee. U.S. dollar to Canadian dollar, Canadian dollar's response. The Canadian dollar appreciated against the U.S. dollar, influenced by reports that Prime Minister Justin Trudeau might resign. This political development led to a dip in the US dollar against the Canadian dollar, reflecting market sensitivity to political events. The Canadian dollar, CAD, experienced an appreciation against the US dollar, USD, last week, driven primarily by political developments in Canada. A report that Prime Minister Justin Trudeau might resign led to increased uncertainty in the political landscape, causing traders to react by moving away from the USD and favoring the CAD. Below is a detailed breakdown of the key factors influencing the movement. Political uncertainty surrounding Prime Minister Justin Trudeau. Reports surfaced that Canadian Prime Minister Justin Trudeau could be stepping down. Political instability, even the potential for change, often causes uncertainty in markets. Traders tend to shift away from assets perceived as risky during such developments, including the US dollar, which led to a sell-off against the CAD. The market response was driven by this uncertainty, with investors preferring the relative stability offered by the Canadian dollar. Market sensitivity to political events. Political events, particularly in major economies, often have a significant impact on currency movements. The CAD's appreciation in response to Trudeau's potential resignation reflects how market participants are highly sensitive to political risks in Canada, especially given the Canadian dollar's close ties to oil prices and North American trade dynamics. Traders perceive political stability in Canada as crucial for maintaining economic stability, which supports the CAD. Oil prices and trade relations. The Canadian dollar's value is closely linked to commodity prices, particularly oil. Canada is a significant oil exporter, and movements in oil prices often have a direct impact on the CAD. During political uncertainties, traders tend to factor in broader economic risks, including trade relations with the US and other global factors that could influence commodity exports. The appreciation of the Canadian dollar against the US dollar was largely driven by political uncertainty surrounding Prime Minister Justin Trudeau. This development created risk aversion among traders, leading to a dip in the USD as investors moved toward the relatively safer CAD. Going forward, traders will continue to monitor political developments in Canada, oil price trends, and trade relations to gauge the CAD's potential movements. Euro to US dollar, Euro stability. The euro maintained stability against the US dollar, with movements largely influenced by broader market trends and economic data releases. The euro's performance was relatively steady, with no significant deviations observed during the week. The euro displayed stability against the US dollar, USD, last week, showing limited volatility and maintaining a relatively steady performance. The euro to US dollar pairs movements were influenced by broader market trends, economic data releases, and ongoing developments in global trade and monetary policies. Below is a more detailed breakdown of the factors contributing to the euro's stability. Broader market sentiment. The euro to US dollar exchange rate was largely driven by overall market sentiment, which remained cautious throughout the week. Global economic uncertainties, including trade tensions between the US and other major economies, continued to weigh on risk assets. However, the euro's stability can be attributed to its position as a relatively stable currency amid these global uncertainties, supported by the European Central Bank (ECB's) cautious approach toward monetary policy. Economic data releases. Economic data from the Eurozone largely supported the euro's performance, with no major negative surprises. Eurozone inflation figures. Consumer price inflation in the Eurozone remained in line with expectations, providing some support to the currency. The ECB's approach to maintaining accommodative monetary policy, given sluggish inflation levels, helped prevent significant downward pressure on the euro. Eurozone GDP growth. Preliminary GDP data showed steady growth, which further contributed to market confidence in the euro's stability. These data points helped balance the impact of external factors like trade disputes and geopolitical tensions. US dollar dynamics. The US dollar remained strong due to expectations of continued interest rate hikes by the Federal Reserve. However, the stability in euro to US dollar was also influenced by the US dollar's mixed performance across other major currencies. As the dollar's gains were more subdued compared to other currencies, the euro retained its stability against the USD without significant deviations. ECB's monetary policy. The European Central Bank (ECB) continued to maintain an accommodative stance on monetary policy, keeping interest rates low and indicating that stimulus measures could remain in place for some time. This approach provided a form of support to the euro, preventing any sharp depreciation against the USD. The ECB's cautious and predictable policy helped to anchor market expectations and reduce volatility in the euro to US dollar pair. The euro's stability against the US dollar last week was primarily driven by a combination of broader market sentiment, steady economic data, and the ECB's cautious monetary policy approach. With no major deviations or shocks during the week, traders and investors expect the euro to US dollar pair to remain relatively steady, barring any significant economic events or geopolitical developments. US dollar to Japanese yen. Japanese yen's position. The Japanese yen's performance was influenced by global risk sentiment and economic indicators. While specific movements were not detailed in the available sources, the yen's value typically responds to shifts in investor risk appetite and economic data releases. The Japanese yen, JPY, experienced movements largely influenced by global risk sentiment and key economic indicators last week. The yen is often considered a safe haven currency, meaning its value tends to rise during periods of heightened global uncertainty or economic instability. Below is a more detailed analysis of the yen's position and the factors affecting its performance. Global risk sentiment. The yen's value is closely tied to risk appetite in global markets. During periods of uncertainty, such as geopolitical tensions, economic slowdowns, or financial instability, investors tend to shift towards the yen as a safer store of value. Last week, global risk sentiment was mixed, with tensions in Asia, US-China trade relations, and concerns over global economic growth playing into investor behavior. The yen showed some strength in response to these uncertainties, acting as a haven currency during risk-off periods. Economic indicators from Japan. Economic data releases from Japan had a limited direct impact on the yen last week. Trade balance. Japan's trade surplus showed signs of improvement, which was viewed as a positive for the economy. However, trade data alone was not enough to drive significant movements in the yen. Manufacturing PMI. The manufacturing sector in Japan showed contraction, reflecting slower economic growth. This development, though not surprising, highlighted some underlying weakness in the Japanese economy, which weighed slightly on the yen. U.S. economic data and Federal Reserve influence. The US dollar to Japanese yen exchange rate is also significantly influenced by US economic data and monetary policy decisions. The recent Federal Reserve commentary, indicating a potential continuation of interest rate hikes, supported the US dollar against other currencies, including the yen. However, this impact was moderated due to global economic uncertainties. Monetary policy divergence. The divergence between the monetary policies of the US and Japan continued to affect the yen. The Federal Reserve's tightening policy stance has been diverging from the Bank of Japan's more accommodative approach, which generally exerts downward pressure on the yen. Last week, while the yen showed resilience, this divergence in central bank policies remained a key factor influencing its position. The Japanese yen's performance last week was shaped by a mix of global risk sentiment, economic data, and central bank policy divergence. While it held steady overall, the yen's value can fluctuate more significantly in response to shifts in investor risk appetite and economic developments. Going forward, traders will continue to watch global risk factors and U.S. economic data, which could impact the yen's movements. Looking ahead, predictions and fundamental analysis. In the upcoming week, several key economic events are expected to influence the Forex market. 1. U.S. economic data, December payrolls report and job market health. The release of the U.S. December payrolls report is a major event that traders will be watching closely. This report typically provides insight into the health of the labor market, including the number of new jobs created, the unemployment rate, and average hourly earnings. A stronger-than-expected report could reinforce market expectations that the Federal Reserve will continue raising interest rates to combat inflation, potentially boosting the USD. Conversely, weaker-than-expected data might lead traders to scale back on USD strength, as it could reduce the likelihood of future rate hikes. Key impacts. Job creation, strong payroll numbers could signal economic resilience, boosting USD demand. Unemployment rate, a declining unemployment rate would support the USD, while a higher rate could weigh on it. Wages growth, higher wage growth could reinforce inflationary pressures, likely pushing the USD higher. Impact on USD, depending on the outcome, this data could shape expectations for Fed policy, influencing USD movements against major currencies like Euro, GBP, and JPY. 2. European inflation figures. Inflation data from the Eurozone and Germany will be crucial for understanding the economic outlook in Europe. Inflation figures will give clues on whether the ECB will need to introduce more stimulus measures or tighten its monetary policy. If inflation remains subdued, it could pressure the ECB to maintain loose monetary conditions, keeping the euro relatively weaker. On the other hand, inflation accelerating beyond expectations could indicate tightening monetary policy, supporting the euro's value. Key impacts. EU inflation rate, a higher-than-expected inflation reading could suggest tighter ECB policy, strengthening the euro. Germany inflation. Inflation in Germany, the Eurozone's largest economy, holds significant sway over regional monetary policy. Impact on euro, inflation figures will play a major role in guiding the ECB's monetary approach, affecting the euro's value. 3. China's consumer prices. China's Consumer Price Index, CPI data will be highly significant, as it provides insights into the overall economic health and inflationary trends in China, the world's second-largest economy. This data is crucial for understanding the pace of China's economic recovery and any potential stimulus measures from the People's Bank of China, PBOC. If consumer prices remain stable or show slight increases, it could indicate moderate economic growth, supporting the yuan, CNY, and broader market sentiment. A stronger-than-expected CPI could lead to expectations of more stimulus measures, which would positively impact the yuan and potentially encourage risk-taking across global markets. Key impacts. Consumer price growth, stable or moderate CPI increases could signal steady economic health in China, supporting the yuan. Economic stimulus. If consumer prices are low, there could be expectations for more stimulus, boosting the yuan. Impact on CNY. Data showing robust consumer prices could strengthen the yuan, while weak CPI could prompt more easing from the PBOC. Conclusion. The upcoming week will bring significant economic data releases that could have major implications for Forex markets. U.S. payrolls report will be crucial for USD direction. Eurozone inflation figures will impact the ECB's policy outlook and the euro. China's consumer prices will influence the yuan's stability and broader market sentiment. Traders should carefully monitor these events to gauge potential movements in the Forex market.